How about let's start with the market? It's changed.
What?
You sure? Come on.
Yeah, just a little bit, I think.
It's been an interesting tail end of 22. It was rough. For me anyway.
Right.
Like it was just the constant transition. Like
So what do you guys think was driving that?
the media. I hate media. I like to beat everyone with a bar of soap.
I think there's
Just
there's no hype. There's no hype to get into real estate.
No, it's doom and gloom right now.
It's all doom and gloom. So I don't think people have been informed.
I think they're largely uninformed, and change. This is change. Change is good. We were in a market that it wasn't sustainable. The last 2 years was insane.
But like, if you asked anyone, like in real estate, who makes the most money in real estate, and when do they make the most money in real estate? Like every book or every podcast I've ever listened to, the rich get richer in these markets. The rich don't get richer when it's at its peak, and so like. Then they sit back when the market's all going up. They're like, "Oh, how'd that guy know to buy in the low markets?" It's like, well, this is not something new, and this is what like I don't quite understand why. Like, I get the media's all the hype, but like, name me one super wealthy real estate agent that made all of his money in peak markets. So this is why I don't understand why the narrative's so bad. It's like every buyer in the world should be like just chomping at the bit to be buying.
Well, it's perspective, right? Like you gotta change your line of thinking. So the last 2 years, you were seeing house prices increase, what, 20-25% year over year?
Right.
That's incredible. You could buy a house, make a couple $100,000 on it.
Right.
No big deal.
Yeah, the long-term Canadian average is what, just under 5%?
It's
Over a
like
20-year
2.5.
period? Oh, I thought it was higher than that, over 20 years.
Oh, it could be. I haven't looked at the stuff on that, but inflation's 2.5, generally speaking. That's where the comfort level is. So that says to me that maybe housing prices should probably match that 2.5 per year. And actually, if you project out like lenders do, like reverse mortgage lenders, they project out using a 2.5 to 3% per annum. So that's typically where the market should be. So when we see 20% or north of 5%, say, that should be considered to be out of the norm. But now, if you change your perspective, like the last 2 years, is obviously was a great time. You could sell a house and say, "Hey, buy now. We know it's going to go up. It's you're going to make money. It's a great investment." To today, when prices are coming down, it's kind of hard to have the same narrative. But the perspective from a buyer should be, this change is opportunity. Because here's the reality: if you could buy a house for $800,000 a year ago, and let's say you just couldn't put a deal together, but you were willing to spend $800,000, that same house today is going to be what, $650,000, $700,000?
7, yeah.
Okay, let's call it 7. Now you're going to end up buying that house for $700,000, the same house you were willing to pay $800,000 for a year ago. Yeah, the interest rates are more, qualifying for it's a little harder, but if you can pull it off, you now own the same house with less money owing. That's a win every day of the week. You know why? Because you have $100,000 less that you have to pay back. Now you're going to pay slightly more in interest, but the difference in the purchasing, if you owed $100,000 more on the property, with a lower interest rate, the carrying cost per month is very similar now, even though the interest rates are up.
Right.
So to me, when I hear people say, "I can't afford to buy a house anymore because of the interest rates," it's probably not true. You just have to change your line of thinking. Now, you can't buy an $800,000 house anymore because of the affordability factor, but that same house is also only $700,000 now.
Yeah. So do people keep in their mindset, like, I was going to buy an $800,000 house a year ago, today that house is worth $7,000, but I'm still looking at $800,000 houses, which a year ago were $900,000. And so then all of a sudden, yes, you're right, you can't afford that $800,000 house. But that's a different house than we were looking at a year ago.
That's right.
You're looking at a more expensive house.
That's why I said it's, you have to change your
right.
perspective.
So it's like, okay. And then when you talk about people in that 25% category, how many people were buying and turning around and flipping 1 year later versus people who had bought, let's say, in the last down market and then were selling it at peak market? Is there were there a lot of people just making it rich in that time, or am I the only person who, like, obviously I'm new, so like, does that question make sense? Like, is there a lot of people just
a small group
doing a
like,
quick
the
flip?
four of us here, like just using the four of us, but I know I've been in the same property through the whole run.
Same.
Yeah,
All
same.
three of us. There's only one of us that made moves through that whole process.
The thing is,
A lot of moves.
Yeah, but
Right.
you've been making a lot of moves for 8 straight years. It's not like this was a lot of moves just because the market was
We were in
up.
Churchill for a bit, but yeah.
so there's
Sorry,
two
sorry,
different
sorry.
groups of people, right? Like, you have people that, like myself, I only own one house. I live there. I'm raising my family there, and I've been there for like 15 years. For me to sell when the market's high, yeah, I'd make a pile of money on the house.
It was
I'd
a
have to-
buy-in on
I'd
that
have to
market.
buy in a high market.
Yeah.
So that's what I would call monopoly money. Like, you know, you sell high, buy high, so it's just a step sideways.
It's a better opportunity right now for people who aren't already in the market
Yeah.
because they're not trading apples for apples.
And they're not
Right.
going to multiple offers on every property either.
Yeah, so there wasn't a ton of people who were doing the, like,
No, there wasn't that many that
buy
were
in 2020 and sell in 2021 before the...
That's right.
I think it's just a matter of just like if it was an opportunity for someone, or their circumstances changed for a lot of people
Right.
with the pandemic, right? Like people lost their work or found better opportunities, so they just made the move and were like, oh, well, made 150K, like got 50K of expenses, made 100K. It's great, amazing, move on, right? I think there was probably some people there as well that were buying real estate that they settled for, as well. And they lived in it and were like, oh, you know what, like this is not meeting our requirements. And so they had to make the change there. And they were just lucky that the market absorbed all of their expenses and gave them a little, you know?
Right.
But we're not in that market anymore. That's for sure.
I think that's good. I think it's a good that we're not in that market.
Yeah.
Going through a period of change, the whole country is, on the economic side of it. The housing industry is a part of that, right? So we're going to go through a period of change. Prices will come down, interest rates will fluctuate. Everything will balance out in the end. But I think it's good. Change is good. We were going the wrong way for too long.
Yeah. I've said this before, and I don't know if you feel the same. I feel like 2023 is really shaping itself for. It's going to be a cash buyer year. Like if it's for people, that's the biggest opportunity. It's going to be for people who are walking in and looking to get in the market. Like spend their money now with the declines. It has a little more push. And like I said, it's not someone who's selling their house and buying a house. It's not. For me, it's not. I'm not looking like it's going to really be a transitional year for a lot of people.
Yeah.
It's going to be more investment people. That
I
are
think
going to capitalize this year.
It's really easy for people who've got cash.
Yeah.
That like every seller wants to know that the buyer's cash, right? Like it gives them a ton of assurance. Buyers can make really aggressive offers and just see who the motivational seller is right now and take advantage.
Mm-hmm.
It's a great it's not just people who like don't own right now. There's a lot of people out there that have one home and got a bunch of cash stored to one side and going, well, I know at some point I'm going to sell the house I'm in, but I don't have to sell it in this market. I can wait until it accelerates again, and I'll just buy the best deal right now.
Yeah,
and move into it when it's time to do
I see
it.
it being
Right?
very much an investment strong year for people. Like,
Yeah,
I think it's going to open a door for people that have been, maybe priced out of the market, or, I mean, there's been a ton of people over the last year that just couldn't get an offer accepted.
mm-hmm.
Or how about the buyer that has to sell subject to the sale of their property? No.
yeah, they have that opportunity now.
Yeah, that's in a lot of contracts right now.
Are a lot of those contracts coming to fruition because they're probably faced with
Very
the
few.
other problems, like
Very
getting
few.
their house sold?
Yeah, I think it's easier for people who are like selling in the lower mainland and in those areas where the market has adjusted a little, but it's still very strong markets. So, instead of it selling in 2 weeks, you give them 30 to 45 days, and very likely it's going to sell in those markets. But moving from within the same region, selling in Penticton and rebuying back in Penticton, it's not like days on market is a lot longer right now.
Yeah, unless you're making a big jump. Like if you're selling something reasonable, like there's still the lower stuff is still moving. We're seeing that, right? So because they're entry level product, there's always going to be someone trying to get in the market, and it tends to be those lower end properties. So people whose situations have changed. You're kind of that 3.5, 4 range to 6.5 range. We're still seeing movement in there. It's just after that now. Before it used to be 8 and above was nuts. You couldn't.
I would say that for
couldn't
single
hold.
family. I would say that for
Yeah.
single family, like the townhouse market is not like there's a lot of people want the entry level stuff, which is like 450 or less. Anything that's kind of in that 5 to 6, 650, people aren't really operating in that. And then the really nice townhouses are 650 plus. People will buy those because they've got views or better square footage or they're newer or whatever.
Well,
But that kind of like mid range just kind of sucks
just-
because they can get single family dwellings now in that price point. They have to fix them up a bit more, but like that price point is more attractive.
what was it yesterday? There was that townhouse or that condo in the towers. It was $1 million. I'm like on the 4th floor. I'm like, what just happened? Like,
Yeah.
it doesn't make sense with where we are right now. But that's a specific buyer looking at a specific product. Like,
Yeah.
But to Dan's earlier point about the interest rates and the house being cheaper and your interest rates up a little bit, are people still who are then buying without all cash? How do you convince them that this is still like the right move? Of like, in essence, you're in the exact same point you were a year ago. It's just interest rates are higher, houses are cheaper. It's like, how do you still convince that person that this is still the right time? Like, I just renewed my mortgage, and I'm a 5-year fixed guy. It's just, I don't know. I like the stability, and I didn't know enough about mortgage rates when I got into my house the first time. My mortgage went up $80. Like, I'm not talking a lot of money here. And but my last interest rate was also 3.89 or something. So 5 years ago. So this isn't like a huge big deal. And I think my new one was like 5.2 or something. It's like, it seems ridiculously high, but I've done nothing but pay sort of higher than average
You've
mortgage
always
rates.
paid really high.
I've always, I also bought a house for $250.
I was going to say 5 years
and
ago,
it was
3.29. That's a high rate actually for 5 years ago, right? Because I'm trying to think. I bought my house 8 years ago. I was at 2.99.
That's probably about right. 5 years ago, stuff was going for
We had a little up.
interest rates were on the rise for a small period of time there.
Yeah.
I think we saw a 5-year fix as high as 3.79 around that time.
Yeah, so it could be that.
Yeah.
It was in the higher threes, so.
So like, everything's cyclical, right? Like
Yeah.
if you end up with a higher interest rate when you buy your house, and you don't have a plan to kind of get out of it before that, but chances are when you come up for renewal, there's a pretty good chance you'll be on the high end of the cycle again, right? So that's something to keep in mind when you're picking your term and stuff.
Yeah, so are you seeing like, people who look more at like maybe 3 years now, and then in 3 years, if the interest rates come down, then maybe buy into a 5-year or?
Depends on the interest rate environment at the time. I got everybody different strokes for different folks, right? So right now I have some clients that are like, you don't really like the 5-year fixed rate. You think it's too high. I'm like, well, the shorter terms are even more expensive, so you're not going to like those.
Right.
And then you have a penalty to break them and all that type of stuff. Or you need to take the variable. And the common reaction I get when you mention variable to people right now is like, you're nuts. Like, why would we take the variable? It's going to skyrocket. Like, well, we're probably at the end of that interest rate hiking cycle. Might be one more, another 25 basis points or something. Pretty minimal.
The damage has been done already.
But the flip side to it is you might have to pay slightly more for 12 months or 18 months, but then when it goes the other way, you get to reap the benefit.
Right.
And also, if fixed rates go lower, because they don't have to move in tandem, like they don't move lockstep with variable rates. So if fixed rates go lower and you decide, I like that fixed rate, you can lock into it at any time. So it's actually a pretty good move, even though you're paying more up front.
Right, yeah, because that's the benefit of the variable is the penalties are a lot lower than a fixed.
They're always only a 3-month interest charge. But if you stay with the same lender, there's no charge to lock into a fixed rate.
Okay.
So there's no penalty
But
associated with that.
you still have to requalify to lock in again. Oh, okay.
No. So most lenders have, you simply call the servicing department and say, I'd like to lock into the current fixed rate and sign the papers and you're done.
That's what my mom ran. Scotia told her they had to requalify her mortgage if she wanted to lock in when interest rates started going up. She's been on a variable, which I thought was kind of odd, but
It sounds strange to me.
sounds like Scotia.
I guess the answer to that question is I don't know what product she was in.
Yeah.
So every bank has different rules and stuff. and
Yeah, because
and
it's
they're not
not
all
more
the
like
same.
the convertible mortgage is kind of what they used to, they called it when it kind of came out. It wasn't. That was where you basically you could lock it in any time without penalty.
Yeah, that's what most variable rates are like that.
Okay, because I remember them promoting it a few years back.
And actually, I'm 100% positive that Scotia's product will allow that to happen.
Interesting. I
So
wonder why she.
I don't know what product. That's why I say I don't know what product she was in.
Yeah, fair enough.
She might have been in a line of credit.
No, I don't think that's it. Anyways, I derailed. I was going off the one person I can think who actually tried, and then they should have got told they couldn't. I was like, that's kind of an odd one, but.
So how's things going in the beginning of 2023 in the mortgage world? What are you seeing?
I'm pretty good. Like I'm happy with the way it started, business wise, interest rate wise. I mean, there's not a lot to be super stoked on. Like the biggest misconception I see in my side of it is that people read the media and the news and they take it word for word. And every time I read a news article about interest rates, I almost always find inaccuracies in it. It's just not the people writing the article they're not mortgage brokers. They're not in the industry.
Well, there's a sensationalism. That's all.
Yeah. So the biggest one I hear is that, oh, interest rates are going up. Like, well, that only is really applicable to the variable rate. Fixed rates don't march in the same direction as those. Now, the statement interest rates are up is true, but if you were to look at where fixed rates have gone in the last 60 days, well, they're trending on the downward trend. And in fact, the bond markets, I haven't looked today, but over the last week, the bond markets are down, which would indicate that we should be seeing further reductions to fixed rates in the near future as that trend continues.
So, correct me if I'm wrong here, but my understanding is that the 5-year fixed rate is tied to the 5-year bond.
Correct.
Yeah, and I wonder how many people today actually know that, like actual buyers, and I would imagine that that's got to be slim to none.
I would think
The average buyer, I guess, yeah.
in tune with that. So if they're not just tied to the bond markets, so they're tied to the bond yields. So when yields are up, so are fixed interest rates. When yields are down, so are fixed interest rates. Typically, as yields go up, interest rates move faster, and when yields go down, interest rates kind of hang behind a little bit to see if that's going to be a trend.
Right. Okay.
So right now they've been trending down. They're at the point now where I think there could be some movement there, but we'll see. Nobody's really moved yet.
What are you finding with the actual lending institutions? Are they wanting to do mortgages right now? Like what?
Well,
Are they motivated?
that's a great question. So a lot of people seem to think that banks and lenders and people like myself want to find a way not to give you money. It's not true. They're in the business of giving you money. They want to give you their money so they can make the interest off the payments that you make. They're actually trying to find ways to lend money out all the time. The problem is for them is that they have to meet government guidelines and their own risk factors, right? So they have to get enough things into the file to make it work, to fit all their guidelines. We call it underwriting to an audit. So if they can check all their boxes off, they'll give you the money. Now, if they can't check all those boxes off, realistically, they can't give you the money. And that's where people don't like to hear the word no. But a lot of times what happens with the underwriting guidelines are put in place in order to protect us from ourselves. How many people would buy a $750,000 house because it's a really nice house? Of course they would. Who wouldn't? And they would say, I can totally afford that. But then if you take a closer look and say, well, our model shows that you can probably only afford $500 comfortably, obviously they're not going to lend you $750.
Yeah, a lot of people who aren't in the market renting or something like that, they always use that comparison. Well, I'm already paying $2,800 a month for rent.
Right.
Why can't I use that as my mortgage number? Well, because it's not how things operate. They want to make sure their money's secure.
Well, it's because if you own a house, you've got maintenance, you've got insurance, you've got taxes, all that on top of your mortgage payment.
Yeah.
Whereas if you're renting, your rent payment is just your payment.
No. That was saying the perception of people saying,
Yeah.
well, I already paid this.
Yeah.
Yeah.
Well, that's they're just trying to justify.
And so then
it
it's like
themselves, right?
taking that client and going, okay, you pay $2,800, so in $2,800, we need to make sure we can pay the mortgage, the taxes, the this, the that. That all needs to be calculated in there. So then that, if you put that into the mortgage calculator that you're picking off the internet, you know, it's not a 2,800 straight across.
No.
It's really
As
15.
we were sitting here, I was just thinking to myself, like, remember when the stress test came in and we all sat there and went, this is garbage. How is this even a fair comparison? And now the interest rates that were in place that they're using at that time are real numbers.
Those things definitely protected peep buyers now. Because if you had buyers that bought when interest rates were like 2%, now they're paying 4.5%. And they're able to get by, but they're not happy about it. Like their interest, their payment went up, $200-300 maybe. They're not super stoked about it, but they're scraping by. And the reason behind that is because, well, they qualified at 5.25%. So as long as they're still under 5.25%, they should be okay.
Sorry, I'm a squirrel, so I tend to. No, maybe you can. I've never been able to figure this out.
Can I stop you for a
Yes,
second? Because I want to expand on that qualifying rate, 5.25%. They really got that wrong. The stress test. In my mind, the stress test should be the average 5-year fixed rate, and it shouldn't matter where interest rates go. If interest rates fall to 1.5%, if the average 5-year fixed rate is 5.25%, that's what we're qualifying at. Because now that we're seeing, like, we're at 5.5%, I think some of the big banks are still up at 5.5%. The qualifying rate then was 7.5%. That's not a I don't understand. It's not a sustainable interest rate. We're not going to be requalifying them at 7.5% in a year from now. Mm-hmm. So what it does when they leave that stress test at the way it is, and we're using that 7.5%, is it drastically reduces how much money that person can qualify for, because their contract rate is still only 5.5%. The other area where that stress test I don't think is very fair is that they're assuming that you would have to, they say, you can't afford this mortgage at your contract rate if rates are higher. I'm like, well, that might be true. So, but when you come up for renewal, you owe less principal amount, right? So you could refinance it if you can't afford. When it comes up for renewal, if you took a 25-year and you have 20 remaining, if you can't afford it at 20, push it back over 25, and now you're probably going to be okay again. So it's not an ideal situation. I mean, it served its purpose when interest rates were low, but now that they've gone the other direction, I think they could just set one standard qualifying rate and just leave it there. It doesn't need to fluctuate.
Would that happen? Could that happen? Has that been discussed right now?
It could, if you had got some
people talking about
people in the government that could wrap their heads around it. But they're
Evie's pretty trigger happy. We could probably do something.
So the mortgage broker industry, we actually do lobby. We have a whole group, a foundation that lobbies against the government rules and stuff, makes suggestions to them, or voice to give the people our business a voice within the government. Right? It doesn't mean that we're being listened to very well. In all reality, I think the big 6 banks have the biggest influence.
Well, I was talking to a dentist the other day, and I don't know if this is happening in your field, but he was talking about how their overseeing board is now, it was like 15 dentists, and they were much crueler, might be the word, but now they're down to 2 dentists and a bunch of people who don't know anything about dentistry. And so they're like, when there's malpractice, it's easier to convince the 13 people who don't know anything about dentistry that, oh, this was an accident and I'm sorry. And then they're being way more lenient on these malpractice suits, whereas the 2 dentists that are like, no, you need to crack down on this person, and they're not. Like, so how much influence is really being projected onto the government in the mortgage broker world? Like, is it a bunch of mortgage brokers that are actually out there and talking to the government with meaningful things, or is it a bunch of now just lobbyists who don't quite understand?
I think it's a bunch of mortgage brokers.
Is it? Yeah.
I think it's the industry as a whole has some input there.
But if you're saying the big 6 banks have all the horsepower.
Yeah.
Yeah.
Oh, for sure.
It's just the reality of it,
Yeah.
right?
Like when they came out with the stress test, the question was put to I think it was OSFI at the time that was creating these guidelines. And the mortgage broker industry was like, well, who came up with the stress test rate? Like, how do we decide what that is? Well, it's the posted rate from the big 6 banks on average. Oh, okay. So the big 6 banks are going to decide this.
Right.
Right? Because
They just admitted to it.
yeah, that's right. So, because the difference was like, why does it have to be so high? When can it just be contract rate plus 2%? Seems like that should be fair, but it would give the advantage to the mortgage broker industry if they did that, because interest rates are generally cheaper.
Right.
So the rule right now is you qualify at the Bank of Canada's 5-year mortgage rate, or your contract rate plus 2%, whichever is greater. So by allowing the banks to set that interest rate at a higher percentage point, it gives a level playing field for everybody. So you can't go to a broker and buy more house because you got a cheaper interest rate.
Yeah, that doesn't sound like it's shady at all. I got to run here pretty quick, but I just wanted to jump back to what I was going to say when I was squirreling out a little bit there. Sorry. So when you're buying a house, we have that fixed, like your gross debt rate, like your debt ratios and things like that. How does it not make any, like, how is that not an across the board lending requirement? It's something that's always kind of driven me crazy. Like,
What do you mean?
okay, so we were talking about the stress test is put in place so to make sure you can afford to pay for your home, right? But there's nothing in place saying I can't go and buy a $100,000 truck the day after I buy my house.
Well, no, because it would kill the car sale industry.
but like I'm saying, like there almost seems to be a blanket, right? At the end of the day, like I understand what you're saying, but at the end of the day, there's nothing guaranteeing that I can still afford that house depending on my habits. Other than you in that first step.
I think it has something to do with, what are the repercussions of it. So if you were to buy a house,
Yeah.
and you've already got the truck, now the truck's included in your
If I already have the truck.
debt service ratio, right? So if we fast forward now, you've got the house, now you're going to go buy the truck. If you don't make the payment on the truck, they take the truck. That's the security.
Yeah.
And so I can see where they're just like, whatever, if the
Everybody's
car
paying on the
industry
house to
wants
take the house too. It's just.
But yeah, I think they're kind of basing the risk factor there. Like, odds are somebody's going to choose to pay for the house over the truck.
Fair enough. I was like, I found it kind of weird. Like,
I do too. I can see where you're coming from.
There's no guideline, right? Like the last vehicle I bought, they just asked me to write down how much I made. That's as far as it went before they contacted the lender and said, "Okay, yeah, it's yours." I'm like, "Cool, thanks." You didn't even take my social.
Yeah.
At first.
No, I agree. I mean, I'm not totally happy about when you talk about more regulations, because I'm like, I don't want to be any more regulated than we already
But
are.
it's just I'm trying to think of a blank, because your regulations really wouldn't change.
No, mine would.
I'm saying
stay the
that
same.
in the ability for them to basically allow people credit cards, like that kind of stuff. Like there's no control over.
In all,
when I was in my worst financial position, Visa just kept giving me more money.
Yeah.
Right. Like
So-
they want to hang you.
I had this conversation with multiple people over the years about, what is really putting people in bad places, right? It's typically not the mortgages. It's not the housing market. It's the credit cards and the car loans, and
All the credits.
you make the credit so easy for people to get that if they happen to go on a spending spree,
That's
they're
kind of
in-
where I was leaning with the whole aspect.
they're in bad position right away, very quickly, and then they're faced with, well, how do we get out of this now? So I don't know, when they came back in 2008, you guys remember 2008? That was a bad time. A lot of people were in bad spots, and they really came down hard on the housing industry, but there was never anything done to rein in the consumer debt.
Well, I think in 2008, 2009-ish, I think it was Alberta, the oil. We're talking about the oil market and everything went for crap too. Like they had guys in the news saying, "Oh, Alberta, we need bailouts. We need help for our housing." And the one guy I remember clearly on the news, he's talking about, "I need a bailout for my mortgages for help." He's got 2 brand new cars in the background, a boat,
Yeah.
Yeah.
sitting in his driveway. I'm like, because it's an oil field worker. Like, there's your out. You don't need to have the brand new diesel pickup. Your wife doesn't need a brand new Denali, and you don't need that ski boat that you have to truck to the lake because you don't actually live near a lake. Like, like that's the kind of thing. Like, that's why I'm saying I hate seeing that everyone harps on our industry as a whole, but the consumer debt is just the Wild West.
Yeah.
Right. Like, nothing would stop me from going down and buying a brand new truck today besides my own self-control, which is ridiculous.
But if you take yourself out of, like, we're looking at it from the perspective of we're the consumer.
Yeah.
But if you put yourself in the CEO of said truck manufacturer,
Yeah.
now you're like, no, it's fine the way it is. It's great. We should probably make it easier for people to buy a truck.
Well, they do. They just keep extending the term. I have to run. I got to take my son to his doctor's appointment.
It's good to see you again.
All right,
Good to see you
see you
guys.
guys.
Yeah,
Take care.
We gotta do this again soon when I
Yeah.
don't have these things. So.
It's all good. Yeah, that's a good point. I was thinking throughout that whole process that a lot of people have already conceded that they're not going to be able to buy a house. So they end up buying a really, really expensive car.
Mm-hmm.
And then so, like, they're making their situation worse by driving such an expensive monthly vehicle that they really don't typically need. And then, but their salaries tend to go up. But they'll still have the payment for 8 years.
Yeah.
Like, in 5 years, maybe their salary is good enough to go and buy a house, but they've kind of handcuffed themselves
So that's,
for another 3 years, right?
I'm
Because
glad you brought that up. Like, in all the change that we're seeing, there's opportunities to be had, right? And
Yeah.
so let's talk about those. I mean, there's some opportunities for people like you just mentioned, buying an expensive car or preparing to buy a house. If you felt like you've been priced out of the market, now's a great time to revisit your situation and say, what do I have to do to get into a house? Because there's going to be an opportunity for you here very soon,
Yeah, for sure.
right? And I think the change, we talked about it yesterday, Traz, with the change to Strata is no longer able to restrict rental properties.
But they can still restrict, whether it's an Airbnb.
Yeah.
And so I think that's a important point to bring up to a lot of new buyers, is because just in the half a dozen conversations I've talked about it, is there, a lot of people I think are running with the clickbait of like, oh, it's no longer rental restricted. And then they read that and they're done. It's like, no, hold on. You've got to read a little further.
Yeah.
And so, I want to make that abundantly clear that this doesn't mean Airbnb is going to explode. And you do have to pay attention to that. It's rental restricted in terms of you can still do the 3-month minimum.
Yeah, 6 or
long-term
12,
rentals.
depending on what the situation is.
But
Yeah, no, that's a good point. I think what it is and it depends on the market, how much this benefits a specific market. Like Penticton, the condo townhouse strata inventory, like 95% of it is 55 plus already. But there was some 19 plus, 35 plus, which for them to be now changed to 55 plus to still maintain no rentals is probably unlikely. But we might have like a handful, maybe 2 handfuls of extra inventory now, where young buyers, young professionals want to buy into it. And the strategy that I've always had with people is if you're going to buy into a condo or a townhouse, you want an exit strategy to be able to rent it out.
Yeah.
So like your 25-year-old buyer, like you can turn it into a rental if you were able to find another 5-10% and buy now a single family house. Or like if the market's timing is not right for you to sell it, then you rent it. Or if you have to relocate somewhere and it's not the right time to sell, then rent it, right? So there's a couple of buildings in town where there's an opportunity to do really well.
And you have a conversation with them in terms of renting it. I just think back to Leon. I was like, he was buying into a mortgage that the rent would be able to cover the mortgage.
Yeah.
Are we still faced with that same scenario if you're telling these people, well, you can rent it out, but, can you rent it out and you have to supplement the mortgage, or you can rent it out to cover the mortgage and away payments?
Yeah, it depends really. Like rents have come down a little over the last 6 to 12 months, but they're still very decent. I think the general rule that I've always had when buying investment properties, if it's like a single unit, is don't spend more than 400. And that's when I was buying those mostly when the interest rates were kind of in like the 2 to 3.5%.
Right.
So there was some people who kind of extended that number when they could get 1.5% to 2%, and they went up to 500,000 now, and the numbers kind of worked. It wasn't the best for the long term because we would expect the interest rates to go up. But are there some condos available for 400,000 or less? Very, very few in Penticton, but way more now because of the rental allowances. So I think a lot of people are going to catch on to that in the next month or two, and even investors are going to do it. So that inventory is going to be sucked up. It will.
Right.
But yeah, how that's going to change the Vancouver market, I don't like. I've been scouring the Vancouver real estate for 6 months now, trying to see how much of it is actually rental restricted. In Vancouver, very little of it actually is. You know, like you can rent out pretty much anything apart from the age restricted stuff. So I'm not sure which markets this is actually really helping. You know, but it's an opportunity. It's an opportunity for your first-time home buyer getting into like a 2-bedroom, 1-bathroom condo for less than 4 close to the beach. Like it's kind of that's the product that they want, and it's comparable, or like very comparable to rent, plus minus. You know, but yeah, that's I would say that's the next month we need to be helping buyers for that inventory, right? It's the stepping stone to something better in 3-5 years from now.
Well,
right?
you did it, right?
Yeah, that's exactly what we did.
Yeah.
And it was the best decision. That strategy. This is a simple recipe to climbing up the property ladder, but it takes a lot of discipline, and it's clearing a lot of debt.
Yeah.
You know, consumer debt, and working with a good financial planner and a good mortgage broker, and working as a team, and having a real estate agent or real estate team that can manage the situation. And you know, like they should listen to you and your needs and what you want, but they're the professionals. They should manage the situation and say, hey, like you might be stretching a bit too much here, as a friend, like saying that. You know, it's hard to say that, you know, but
I think I've said that to you.
yeah, many times. That's why we work together a lot, because I'm always optimistic about every situation that I come up with. But you create the balance for me, and there's some times where I pursued it, and other times I didn't, because your input was invaluable at the time. But yeah, like I actually hope there's going to be more inventory coming on the market, and if the interest rates stay where they are, I think there's still lots of opportunity. Lots of opportunity right now.
I'm excited for where the market's going. I think there's, like you said, opportunity is going to be more plentiful as the year goes on. I think prices will start to level out. I don't know if they're going to come down significantly more, maybe another, 5 to 10?
Yeah. I think for like what I'm finding, and I'm trying to I look at the conditions of the market and the motivation of what's happening and the amount of inventory that's sitting on the market. This just reminds me of 2019.
Yeah.
Interest rates are higher than what they were then. But that single family house right now that's got pushed up really high, between 8 to 1 million, and still needs a ton of work, I think that is going to be a 15. There should be you know,
as it should be, right?
Yeah,
right.
Yeah. Anybody that's looking at a 950 product right now, that's kind of 60s to 80s inventory, really should be hammering 10% off that price, because maintenance is due. Roofs, furnaces, like all of that. You might as well go and buy $1 million property that's built in like the 90s and 2000s, spend the extra money, and it's cheaper to fund that newer house, that newer or more updated house than the old house, you know. Yeah. I don't know, like the condo market right now,
It's hanging in there, isn't it?
It's entry level stuff, so it's pretty good. But like a lot of the inventory is the new tower on the south end of town, and like they've done some pretty decent sales in there, but there's still a lot of inventory there, and if that's going to be occupied in the next year or two, that's a long time for people to wait in such a perhaps an uncertain market, and they want to look at standing inventory, but there's not that much great standing inventory. So you're still paying $500,000 for a decent condo, especially like the steel and concrete buildings. You're probably going to be closer to like 550 now, plus minus.
Yeah.
Which is an interesting situation because you add the condo fees on top of that, and really you're a 650. You're probably funding a 650 detached home, and that's the market to be looking in. Is like, oh, those really kind of interwar small houses selling for 650 over the last couple of years, really like small square footage, 800 to 1,000 square feet. They're coming down to 5. All right, it's already happening.
Yes,
it's actually already happening. So I think people could look at that as an opportunity and go, well, I couldn't afford that house last year. I should be able to buy it now. Yeah. And maybe moving away from putting the pressure of condo onto condo, and going into single family house, and just taking a chance on like throwing a 10% or 15% less than the asking price, and seeing if it can stick. I don't think anyone should get attached to a particular property if
hit the space bar.
If they shouldn't get attached to a particular property because there's going to be a lot more inventory.
Yeah.
So if you're just looking like, oh, I want a decent single family house, it can be small square footage. Well, we're going to have a bunch of those coming on the market and at a reasonable price. So just take your time. Take your time with like actually solidifying the right one, and don't rush into the first deal possible. I think there's other buyers where they have a very specific strategy where they know exactly what street they want to be on, or like so they've already done all the qualifying over years to know exactly where they want to be in a neighborhood. I have buyers who do that pretty much north of Westminster, like on Churchill, Alexander, Heels. I have clients who do that in Uplands area and Redlands area. Like that inventory just isn't plentiful. So they're going to spend more money right now, but at least they're going to be in there for 10, 15 years. So that kind of goes back to your point of like, it doesn't matter if you think that you're not buying it at the rock bottom of the market. Like you're going to be in it for 10 to 15 years. Who cares?
I preach this to my customers all the time. Like, trying to time the market to sell when it's high. I mean, if you're not living in the house that you're selling, you can do that. Yeah. But trying to time the market to make sure that you buy at the bottom can also be detrimental too, because you might watch the right property go by, right? So what I like to tell people is like, hey, this is your budget, and you know what your lifestyle and what your needs are, and when the right house shows up that's in your budget, that's a great time to buy.
Yeah.
Right.
No matter where you are on that.
Well, if you think it's coming down, maybe you can negotiate the price a little bit to offset it. Maybe if you think the market's going to go 10 and you get 5 off the asking price, I mean, so what? So you get closer to getting a good deal than you would have by paying full price.
Right.
So you kind of offset it a little bit. But the reality is, if you're thinking long term, and you should be unless you're flipping houses, in my opinion, 5 to 7 years is what your mindset should be at to be in a house at any given time. So if you buy a house today, and we're on the down side of things, 5 years from now, there's a pretty good chance that's going to be worth more than what you paid for it, even though the market's correcting right now. So the idea that you're going to lose money on it, I don't think that's a real big risk. Now, it's different if you're buying today and thinking maybe I'm going to sell in 2 or 3 years. You might be running a bit of a risk on that one.
Yeah, for sure.
Right.
I wonder if people actually have that mindset right now. Like if a buyer client came to me and said, "Hey, like I'm not sure how long I'm going to be in this. Like my work contract is only for 12 months or whatever," then I would just advise them to rent. Like it wouldn't make sense, the expenses of getting into that property.
Oh, absolutely.
Not in case they said, hey, like at the worst case scenario, I don't mind making it an investment property and I'll make more money to buy something in my next location or whatever. That's fine. And then I think a lot of people don't probably get that advice of like, it's actually okay to be a renter for a while. You know? Like if you like, there are more rentals on the market right now than there has been in a long time. So do the smart thing. Yeah, just kind of take your time, like, and come up with a strategy of like what you actually really, really want.
Well, that was the nice part about the earlier session is like when you're talking about that graph is like if you talk about the market graph and the up and down and like how many people know which side of that little bell curve or upside down bell curve, if you want.
Maybe explain that.
Which is the buyer's side and which is the seller's side.
Yeah.
And most people want to be a buyer in the seller's market because they see the market going up.
Yeah.
But like, because they're afraid to lose the bottom half because you don't know where it's going to bottom out. So you're afraid to buy in this like downward trend. But, you know, if
That's
you
where
look
the opportunity is.
if you look at the 60-year forest of this graph, all of a sudden like the whole thing's gone up, but these little blips are happening as you're going up.
Yeah.
And
I use that graph all the time.
yeah, and
Right?
I've just never been put it that way, and I was like, oh, that was so enlightening.
So I break it down a
Nice
little
to
bit
show that.
simpler. Like,
Yeah,
you know, there's the graph with the ups and the downs, and then there's the median line.
right.
Now, the median line is basically that's the reset line all the time, right? So when people talk about market corrections and stuff, they're actually very predictable. If you remove outside influences like the economy as a whole, whatever the reason happened to be for the downturn, we know that over the last 60, 80 years of real estate, every roughly 10 to 12 years, there's a market correction. And for different reasons every time. This time it was the pandemic, right? Actually, the pandemic propped prices up. It was kind of crazy. We were actually heading for a correction in 2020 until March, and then the market took off again. But prior to that, we had, 2008, and then previously to that was it 2002 or something? Somewhere around there. So every roughly 10 to 12 years, we have the market correction. What's interesting is that when the market corrects, it falls back down to the median line.
Right.
So right now, the interesting part about this, when people ask me, what are we predicting is going to happen? Well, in 2022, June, July was the peak of the house prices, I think. The median line was like 40% below that.
Right.
Right? So people ask, well, how far is it going to fall? Well, it doesn't fall straight down. It comes down on a gradual basis, and the median line continues to go up. So we're not coming down 40, but maybe 20, 25?
Right.
Right? We're already 10.
Yeah.
We talked earlier about maybe going another 5 to 10, maybe more. So it's interesting that I don't have to know anything about what's going on in the world. I'll have to continue the graph, the pattern that already exists. It's actually pretty accurate.
Right.
Yeah, that's a little bit frightening when we look at it in that way, because there's so many people who paid so much for properties with so little down that they could get into a negative position very, very quickly if it drops so much.
But if they just wait long enough.
Yeah, but that's about a lot of people will
Panic.
panic. Yeah.
Right.
Yeah, and a lot of people didn't. I think there's a lot of people that were just there, like maybe they were hopeful that they'll be in it for 2-3 years. It makes a little bit of money, then they can move into something that they actually want. So I think there's going to be a lot of people who are sticking around in a housing product for a lot longer than what they initially hoped for.
Yeah.
Yeah, and
First world problems.
Yeah. Well,
Yeah.
a friend of ours bought an acreage, and he did the variable rate, and so he's like an extra $2,000 a month right now in mortgage payment. I was like, Jesus.
Yeah.
You must have a pretty hefty mortgage.
Oh yeah.
Yeah.
It's not on the small side.
Yeah, I get that. You know, the variable rate.
It's like, oh, to your earlier point, I want to go tell them, like, just hold on. You know, so it's,
Well, you know, that was a tough spot, especially in my being on my side of the business. People remembered 1.5% 5-year fixed rates.
right.
They actually existed. You could get a 5-year fix at 159 for like a couple months there. So people saw that, and then they would phone. They want to do buy purchase happen, and we were at 3.25% 5-year fixed. And the response was usually, "That's astronomical. I don't want to take that." So, well, the other option is like you could still take the variable, and you'd be paying like 2%, or even 1.45 right now, right? And so, well, let's do that. And like, what do you think the projection is going to be on that? Like, well, I don't have a crystal ball, but if we rise interest rates that quickly, historically, that would cripple the economy, and I don't think they could rise them that quickly. That's typically the conversation you could have, right? Fast forward 3 months, and the Bank of Canada is like, "No, you know, Mr. Macor, you might be wrong on that."
Right.
Right? So, yeah, I did end up with egg on my face there as interest rates rose a little bit. So was it bad advice? I don't know if it was bad advice. We were, you know, dealing with the information we had at the time.
Unprecedented, sort of.
It rose quicker than you could really jump and drive with, right?
Yeah.
And when all the people in charge were saying it's not going to climb up that much, and it's documented online that that's what they said, and it went completely opposite way. Like how else could have you, like, you took that information and
well, we put
those credible to some degree.
You try and balance it out. Like, what are the odds that you pay more than 329? Well, yeah, maybe it's likely you might end up paying more, but I think it might be a short period of time. And then they've obviously gone almost double what we thought they were going to go, which leaves some people in a pretty bad situation, because how do you advise them then? Because once we started realizing the Bank of Canada is not slowing down, they're going to keep going. Fixed rates were now 4.5%, 5%, and 5.5%. So how do you advise these people that they're paying 4.5% on the variable rate? Should you lock into the 5.5% that's now available in the fixed rate, or do you ride out the variable now?
Yeah.
And so you kind of trying to walk that line of being, I know it keeps rising, right? But there's not really a win to lock in now, because the answer now is that the opportunity to lock in the cheaper rates come and gone.
Right.
So now how do we keep you moving in the right direction? And locking into a fixed rate now, talking about the bell curve, the rates are at the top, right? So the best advice I can give people, if you happen to still be in a variable, is to continue to ride it out for now. Eventually, the time will come when fixed rates might be more attractive, and you might say to yourself, I would like to lock into that now. Right now is not that time. I don't think the variable rate's coming down this year. Towards the end of 2023, maybe in 2024, there might be some movement on it, but I don't believe that Tiff Macklem has any interest in reducing the interest rate. Not after watching it rise, inflation rise the way it did. He's not going to work this hard to get inflation back down and then lower interest rates again very quickly. You can argue, you can talk about Tiff Macklem at another time when we're not being recorded.
Well, and this doesn't this start to play more into the overall economic factor? Because I remember when I was talking to my staff, how long ago was it, that minimum wage was 10%, and they were talking about this $5 minimum wage, and just trying to explain to them basic economics back then of like, you're going to get this $5 minimum wage, and they're like, well, prices aren't going to rise. I'm like, they have to rise. Because you're now making $15. That minimum wage guy walks in my door, I'm paying him $15 tomorrow. And then you're going to want a $5 raise, bare minimum. And so the lag that you're going to see, everything's going to go back to this economic norm that we face, and you're going to be back into this poverty situation that you think you're getting out of. But you're only getting out of it for the window of opportunity till all the prices go up and hit. You know, the guy picking apples is now making $15 an hour, but you're not going to see that until the apples get picked.
Well, yeah.
And so here we are in these, like, it's always going up, and this is that inflationary rate that they're trying to keep at 2%. But when some governments make a minimum wage increase of 50%, you know, all of a sudden inflation can't stay at 2 without some other economic factors playing into that.
There's so many things at play with inflation. For one, you can't tame inflation by raising interest rates.
Right.
You actually add to inflationary pressures by raising interest rates. What you're doing by raising interest rates is breaking the system. You're raising them to a point where nobody can afford to spend money. You're forcing people to save money just to make the bare necessities get paid.
Right.
Right? So, you know, I don't know, raising the minimum wage from whatever it was it 10? They went from 10 to 15. All that did is the guy that was making $20 an hour, he didn't get a $5 an hour raise.
Certainly not right away.
But, well, they are now.
Yeah.
Right? But there was a real problem there because you took minimum wage and said, we have to raise minimum wage to meet the basic living necessities of life. But then everybody who was making more than minimum wage didn't get a raise. So here's the difference. When I was 18, I made like $26 an hour or something painting cars. Today, those same painters make like $30 an hour.
Right.
That's like 25 years later now.
And that's when I talk about in that gap of, like, you know, it hits them, but when, and it's in this zone of where you think you're doing great, because like all those kids that went from 10 to 15, they're spending like fools. And then everyone else goes, like, all of a sudden that painter who's making $20 is now looking at this guy who was making 15 and he got a raise because he's obviously more valuable than the minimum wage kid that I just hired. And so then, but it takes that trickle effect before it gets to you.
Well, it's a whole other problem, the social problem, right? Like back when I was 18, I think minimum wage was $6 or $7 an hour. And so for them to go from 7 to 15, that's doubled. The cost of living doubled. That's what the government's saying by raising minimum wage.
Yeah.
So if I was making 26, or even if I was making $25 an hour back then, should I not be making 50 today?
Well, it's not the exact doubling, right? It's always this like progressive scale as it goes up.
It should be though. It should be though, because the skilled laborers didn't get any reward for being skilled. They stood still, where the lower end crept up and everything else crept up expense-wise because of inflation year over year over year. I mean, there's got to be, the reality is that wages haven't kept up with the rest of the world around them.
Right.
Right? So if you were a skilled laborer 15, 20 years ago, you had a higher standard of living then than you do now. That's a bad thing in society, because those, right now they talk about there's not a lot of trades out there, right?
Right.
People aren't entering into the trade schools.
Right.
Well, you wonder why.
Yeah, it's not
Right.
incentive to. Yeah.
Right? So we could talk all day about that.
Well, but doesn't this end up buying into the house? Like, it all becomes a part of the whole. And when you talk about interest rates, it's like people have to have a general understanding of economics as a whole in order to really want to buy into it. Because I heard it when I started designing homes. It's like, I can't afford it. I can't afford to get into the housing market because I'm a 20-something-year-old kid. Today, I hear the exact same thing. I can't afford to get into the market. I'll never be able to buy a house. I was like, one, with that attitude, true. If you never think you can accomplish anything, you will never accomplish anything. But how do you make them understand? It's like, you're right. You're not going to afford a house, block off the water when you're 20-something. But you look at those skilled laborers, they didn't become skilled overnight, and they didn't, your parents didn't buy a house overnight. But we have this like entitlement issue, or I deserve a $500,000 house when I'm 20. No, you deserve really a condo that's maybe not that great, and it's more in what you can afford, which is
or the house.
$300,000, and let's work you up to the $500,000 house, right? Like, me and Taras, talked about my house in the beginning. He thought I built my house in the wrong part of the world. And I should have been on the Naramata bench because it'd be worth more. But I couldn't afford the $100,000 extra on that lot. I got that lot for $100,000 cheaper. And so now, it's like that progressional step. Like, I couldn't afford the extra $100,000 then. And I made the choice because I bought what I could afford, not maybe in the most ideal location.
And I think that's I'm doing a lot of talking here.
That's good. This is why I am.
I think that's where it's most important for if you're a first time buyer, especially, to find some people that you trust, that you get along with, because you're going to do a lot of time talking with them.
Mm-hmm.
So, for instance, it for somebody to come in and meet Taraz, and Taraz says, "You should go talk to my buddy Dan." And then I say, you should go talk to my buddy Andrew, who's an accountant as well. You got to have the whole team there.
Yeah.
Because you need to find out where you stand. So if you're a 20-something-year-old fella looking to buy his first house, you need to know how much you can afford. You need to know what's in the market that's in your price range. And then you want to start planning for your future as well, which is where an accountant and financial advisor come into place. So there's a whole bunch of needs that can kind of be worked all into one. But if you don't start with a plan, if you don't start piecing it together one piece at a time, if you think about buying a house like a checkerboard, you just keep putting pieces on the board until you get to your end goal.
Yeah.
You don't put them all on the board at one time, unless you've done your homework. I know I didn't. A lot of times you're like, what do I need to buy a house? Well, you need a down payment. Do you have a down payment? No. Okay. Maybe start working on that. So now you know how much do I need? Well, if you spend $400,000, you need a minimum of $20,000. So, that's not too far out of reach. $20,000. It seems like a large sum if you've got 0, but if you've got 5 already, maybe getting to 20 is not that difficult. What are my options if I don't have time to save 20? Well, you can get a gift from mom and dad. That'll jumpstart your purchasing power, right? Oh, suddenly now you've got the down payment because mom and dad got some money to give you. So then the next step is, what do you have for income? Well, I'm working at Walmart and I'm making minimum wage. Okay, well, that's not going to buy $400,000 worth of house, so we need to get income up. So if you're the type of guy who's motivated, you start climbing the ladder in the employment industry, right?
Or take a second job. Or a third job.
Take a second job or a third job. You do what it takes, right? You get there. And then now you say, I've got the job. My mortgage guy says I can afford this stuff. Up to $350 he says I can afford. And I say, now you need to go talk to Taraz. Because the first thing you're going to say when I say you can spend $350, there's nothing available at $350. Nothing livable. I say, you need to talk to Taraz because he knows of places that are. He'll find them for you. Well, they're not going to be a detached home.
No. And that's managing that expectation, right?
Yeah.
And that I don't know. I could be wrong. I could be getting old, but I'm feeling like that's getting harder, is managing that expectation. Like, especially when you go get a credit card. Like, I can't tell you how many of my employees have a $10,000 credit card, and like, I know I'm probably a rare beast. I keep my credit card the same size as my paycheck. So my worst case scenario, I max out my credit card. One paycheck pays that thing off.
Yeah.
And I'm in a good position to get. I'm not like drowning in this Visa debt. Like, I did it, and sure, when I was in my 20s, I had like a $15,000 credit card, and I was maxed out, and I was like, what the hell am I doing? Like, this is crazy. And like, people, get themselves into these positions because credit card companies want to make money, and no one's taught them like financial responsibility. I was in a good position where I could pay off that credit card, and I was like, this is silly. I'm never going to do this again. One interest payment at that, and I was like, this is bonkers. But like, how do you teach them also, beginning to like save money if you can't get it from your parents? It's like, well, spend less. Well, but I need all these things. I have to be able to go to neighborhood brewery once a week and go have tacos and beers with my friends for $30 or $40.
Still don't do that.
Right? It's like,
It's because you don't like people, Dad.
I was like teaching these kids, you will need to sacrifice. I got the luxury of going to a school and doing a business lecture, and they're big on acronyms for things. And I was like, well, have you heard of PPS? And they're like, what the hell is that? And I'm like, passion, persistence, and sacrifice. If you don't have passion about something, and you're not persistent, you're not willing to sacrifice anything, you're never going to achieve anything in business.
Yeah.
But we don't want to hear about that S. We don't want to hear about the sacrifices we need to make. It took me, I was in business for like 15 years, 12 years. I was driving around a 93 Honda Civic hatchback that my wife got when she was 16. It was free. It cost me $20 to fill the bloody thing. And like, I owned 3 bakeries. I had some homes. I had some rental properties. And like, my employee is driving around a Ford Mustang.
Yeah.
I was like, it's crazy. Like, no wonder you can't afford a house. He's 18. It might have been a Charger or whatever. And he's like, well, I'm like, what are you paying in insurance? It's like $3,000. I was like, 18-year-old kid in some sort of Charger. It's like $8 a liter. It's just like none of it made any sense at all. I was like, no one, you're never buying a house if you keep making financial decisions like this. And so I was like, you need to like peel back the spending and talk about like, let's do things in the right manner. But he would not sell that car, not save his life. But it's just the way that is.
What do you think about the lower end of the market? Like, over the last, let's say, 5 years, progressively I've seen less and less. Like, I don't think I did a first-time buyer. I shouldn't say I haven't. I did very few first-time buyers in the last 3 years. So that tells me they've been priced out of the market. So what do you think? Is that coming back? Is it going to be a thing in the future?
That's a hard one because, like,
or are they just going to have to work harder?
I think people are going to have to work harder because it costs so much to build brand new. Like, even just like a tiny little condo brand new is $500,000, right? Like, to build that. So the standing inventory that's 10, 20 years old, you can move into it now. So what is it going to be, $450? It's a little bit older, but you can get into it now and you'd have to wait a year or two. So like those price points, they probably can come down a little, but I don't think you're going to get a $350 townhouse anytime soon. Like, I think there is some like wood frame buildings you can get into for like $350 for a condo right now in Penticton, but it's with rents where they're at, it doesn't really make sense for people for property owners to sell those more affordable units at that price. Like, it doesn't. They should just rent it out. Like, they should just rent it out and make more money that way. And but yeah, I just don't. I don't see the bottom. I think that plus also surprisingly, there's actually quite a lot more investors and property developers contacted me over just the last month or two going, hey, like, we actually want to start building again, and can you get us a lot that can do 4 units? So you need a 60-foot wide lot to do that, right? Maybe a 50 if you did like a 4-plex instead of 2 detached duplexes. And I'm like, well, that's still 500 for that, and that's still a lot of land cost per unit. There was a time, like pretty much 2015 to 2018, where everyone was like, I need to make it $100,000 a door. So we were everyone was snapping up the 60-foot wide lot for 400 or less, sticking a tenant in it because tenants were paying crazy rent, and it held out. So I don't think we're going to get that cheap. I think people are just going to have to probably make more money, work more jobs, spend less money, and to get into housing. especially when you're in a city where you're landlocked by 2 lakes, Crown land and First Nations land. Like, there's just not more land coming up very easily. And if it is, it's a $250 to $450 building lot, and you have to spend $1 million minimum to build an average house now.
So what can be done outside of the housing industry to ease that? Like, if they price out first-time buyers, we're going to lose. And we're seeing it. Like, I know of several people that were just like, you know what, the heck with it. We're sell it all. We're moving back to Alberta. Or
yeah, there's a lot of that happening.
Yeah.
Like, I have a friend, a carpenter, and a client of mine. Like, they flipped a few houses over the last 5 years in Penticton, made really good money, and after the pandemic, they were like, well, Alberta's really cheap and we could be mortgage-free now.
Yeah.
It doesn't really matter where we are. Like, there's going to be work in that industry anywhere.
So that kind of brings me back to here. Like, if we keep seeing that trend, you're not going to have the young people here anymore. You're not going to have the entry-level people. Even people that are in their midlife, in their 40s, tradespeople. If they're not making the money here, where are they going to go? Like, I feel like they're going to leave.
Yeah, that's a very.
So can wages be propped up? Should we be working harder to lobby for higher wages throughout the valley? Because they lag behind everywhere else in the province.
Yeah, that's.
But isn't that going to go back to the exact same problem we face with raising minimum wage from $10 to $15? If we continue to raise wages, everything else is going to.
It's already up. Mm-hmm. It's already up. We're not saying you have to raise lower end wage. You have to raise the middle class wage.
Right.
Yeah.
Well, the nurses' contract is being negotiated right now, and just found that out. So we'll see where that ends up going too.
I'm sure that'll benefit them in the end.
Yeah.
Yeah, and as it should. I mean, you look around the Okanagan here, and you can point to just about any industry. And I think I talked about it with you on the phone yesterday, where you have an example of dude working down at the coast gets paid a lot more doing the same job than he does here.
Mm-hmm.
I don't understand the mentality behind that. There's just less work here, so there's less competition for wages.
Right. I think it comes down to like how big of a priority is to live in the Okanagan. Like, there's a lot of people who have had families here for multi-generations, and they can see themselves leaving. So in that circumstance, if you're in that situation and you want to get into the housing market, I think there has to be like a mindset shift of and changing your expectations to now going, okay, well, I'm in my 20s, like, I'm either gonna stay at home and live with my parents until I'm 30, or maybe there's a way now where me and my siblings can go and buy a house and we share a house together, and that's how we start together.
Yeah.
Or best friends or cousins, or and just kind of make that sacrifice, that would be people have to retrain what they think that they could have had 20 years ago.
Right.
But they need to be informed of like the options, or that kind of creative thinking. Like, is enough of that happening right now? Probably not. I think it'd be really good if, like, in schools and stuff, people actually taught more business, and like how to deal with life situations, and be as creative as possible. That's probably the direction if someone wants to stay in Penticton. That's been happening in Vancouver for a really long time. Like, a lot of people are just trying to buy real estate together, But I think what it comes down to at the end of the day, you can accomplish what you need, but you just have to put more hours into working, and that's such a massive compromise for people.
But I didn't move to Penticton. The sacrifice, Traz, I came here
Right?
to the beach.
Yeah, I'm like, I was at the same mindset. I was like, but I'm going to grind now, and then I'm going to have some security in what I've built, and then I'm going to enjoy it. But is everybody trained, or did they grow up with that mindset of like not having that impulse and feeding your need instantly? Nah, that's kind of diminished a lot over time.
I'll give you one thing I'll tell people that are wanting to get in the market. Number one thing, stay out of debt.
Yeah, it's a big deal.
Right?
Yeah.
It's a big deal. Once you have debt, it's very hard to get out of it.
To follow up on that, then most people would say, well, I need to have some debt to show that I've got good credit. So what would your response be to that?
Okay, so credit cards work. You basically you have to have a credit card, at least one credit card, preferably two, and you should use them as in you use them and pay them off back to zero every single month. So when you get your credit card statement, there's a statement date and a due date. You want it to have a balance on the statement date, and you want it paid to zero before the due date.
Right.
Okay, because if you have credit cards and they have zero balance, you'll probably end up with an okay credit rating, but it won't be like great. And if lenders look at it like that, it's been zero for ever. Big deal. It doesn't have much of a history here, especially if you only have one card that's got a $1,200 limit.
Right.
The idea is to get your credit cards that have $3,000 plus limits, and then let them show a balance every month and pay them back to zero. And you don't have to use them both. You use just one. Right? It's lenders want to see that you can manage credit. So it's one thing to have a credit card with a $10,000 limit and owe $4,000 on it. They would consider that still like managing your credit reasonably well, because you're below 50% of the maximum use. It's another thing to have three credit cards with $10,000 balances each, and they all have $9,500 going on them.
Right.
That's probably going to drag your credit score down a little bit. Lenders are going to scrutinize it a little bit more, especially if you're looking to borrow as much as you can on the mortgage side of things. They're going to look at it and say, well, what is the likelihood they're going to get out from this debt now? Like they're approaching a leverage position, but it's not favorable to you as a consumer. So they do ask a little bit more questions, and it impacts the file a little bit. So there's quite a bit that you can glean from a credit bureau, right? But you should have, and as early as you can in life, if you're 20 years old and you don't have a credit card, you should be getting one. Go to your bank, get a credit card. And if you can't get one, buy a car. One that you can afford.
Right.
Right? So,
well, and like, how do you give that 20-year-old a $3,000 credit card and their first purchase isn't like a giant flat screen TV? So they can go, or a gaming computer, or some sort of nonsense.
you know what? I don't care what they buy with it. I mean, if they want to go buy a TV and they put it on their credit card and they pay it off by the end of the month, that's the same as paying cash for it, right? The problem is if they buy the TV. I wanted to say VCR, but nobody buys those anymore.
Wow, we're dating ourselves so we know what a VCR is.
So they buy a TV, they buy a stereo, they buy a gaming center, and they buy some gifts, and they go out for dinner and some drinks. And pretty soon, now they owe $4,000. And the monthly payment's only $40.
Yeah.
You're not paying it off then. You're just paying the interest. So that's where it becomes a problem, because now that $4,000 is something, and then a year goes by, they still owe $4,000. He breaks his leg, can't work, and now he's got this $4,000 he's got to keep paying towards, right? Or loses his job, or something happens, and then you get behind, you miss the payment. Now your credit rating is dinged. Now you miss two payments. Now it's getting real bad, right? So now you get back to work, and you're like, oh, I want to buy a house, and the lenders go, oh, how come you miss these payments on your credit card? It's an issue.
Yeah.
So management is what it's about. It's not about, having a credit card. Having a credit card is good. Having the ability to borrow money instantly is good, in my opinion. Because I'm pretty good with my stuff. I don't have a lot of outstanding debt. But I know in the back of my head that if a good deal came up on something that I thought I could make money with, I can get the money to make that happen pretty quick, right? But it's about making smart decisions with it. You don't want to take a huge risk and throw 10 grand on a line of credit and then find out that your 10 grand is going to turn into 5.
Yeah.
So you said there's a few things that people could do. And one is to not have any debt. What else? Like to kind of get into the housing market and take advantage of the opportunities that are in the marketplace right now.
Well, you want to go in with no debt. especially if you're a first-time buyer, because you want to maximize your purchasing power. So, I mean, we have two different ratios when we talk about qualifying for a mortgage. One's a gross debt service and one's a total debt service. Total debt service includes the mortgage, taxes, heat, and all of your outstanding debts. So if you have car payments, all associated with that. And there's another one called the gross debt service, which is just the mortgage, principal, interest, taxes, and heat as a percentage of your income. That's the lower one. So it can be up to 39% if you have good credit, and the other one can be 44%. So there is room for you to carry some debt there, but you don't want it to be a huge one. Like, you don't want an $800 truck payment. To put that in perspective, $800 a month towards a truck payment, that's basically servicing somewhere around $150,000 worth of mortgage funds. Right? So when people say I can't afford the $500,000 house, and they're telling me I can only get like $350. Like, well, yeah, but it's the truck payment that's hindering it. It's not anything else, right? So you kind of want to have a conversation with somebody like myself to see where you're sitting. What steps do you have to take to put yourself in the best position to make stuff happen? Especially at a time like this when things are changing, because there are going to be opportunities. I've heard people say before, like, I looked into getting a mortgage 3 years ago and it didn't work out. Like, well, that was 3 years ago. Maybe things have changed. I don't know. Maybe it got better. Maybe they got worse. I've actually surprised myself working with the same customer, seeing how much their situation can change, like in 3 or 4 months.
Right.
Right. So when they first come to see me, I'm like, it's not looking that great in your current situation, but if we take these steps, we can actually push you into that price range that you want to be in. And that, their eyes lighten up and they say, yeah, that's doable. We can make that happen. Right? So it's a mindset thing. But if you're not willing, the same thing you talked about, if you're not willing to put the sacrifice in and the effort in, you get stuck in that never going to happen syndrome.
Yeah. Plus, maybe I should wear, especially with those young people that come to see me and say, oh, well, because I've been out telling everyone now I'm a real estate agent and you can't afford to be in the market and try and change their expectation, but like really sending them to you, like you were mentioning, sending them to a mortgage broker, sending them to an accountant, and go like, if you think it's unattainable, these guys will help you figure out how it becomes attainable. And then once they kind of point you in the direction of what's attainable, then come back and see me. And let's go find you that right thing. And especially if you're willing to sacrifice distance too, because like Karen-Mies, it's a 30-minute drive from here. If you're just coming from Vancouver, 30-minute drive is nothing. Yeah. And all of a sudden, like, this becomes a much easier conversation if you're willing to go further abroad. It's that stepping stone that you could get back into the Penticton market.
I do caution on that though, because you're taking them outside of the market that keeps them in step with the market they want to be in. Yeah. I mean, once you push somebody out the Karen-Mies, it's not going to increase in value the same way Penticton does. Yeah. So once you put them out there, you want to be very careful that they're not going to get stuck out there.
Right.
Right. So
that's true.
A lot of times, what I tell people is that you gotta change your mindset. Like, if I say to you, if somebody says to you, we can't qualify for this because your income is such, and you throw your hands up and go, okay, well that's that then. I guess I'll just go home and continue renting. Okay, that's your choice. That's fine. But if you're serious about making a home purchase happen, maybe a second job, or maybe start looking for a pay increase, or maybe start looking for opportunities elsewhere. That's how you get ahead in life, right? Like, if you don't like where you are, then you take steps to change where you are. I think that's what separates a lot of people. People that are moving forward and taking up different steps, as opposed to those who are, this is my job and I get a raise and it's not going to increase enough to get me to where I want to be. So I'm just stuck here. Right?
But like, buying a property is a long-term pursuit.
Yeah.
It's really easy to go to a car dealership and walk out with like a very fancy car in a day.
Yeah.
Right? So it really comes down to the person at the end of the day, whether they're willing to spend 2 years to actually cementing the plan that they've come up with their professionals, right? So that's a lot of commitment, right?
And a lot can change.
And a lot can change. Yeah,
Right?
yeah, totally.
So I think that was what was frustrating for, if you had somebody that came to see you in 2019 and were like, you need to take these steps and in 6 months' time, you'll be able to get that house. Well, they came back in June of 2020 and you were like, you can't afford that anymore.
Yeah.
So the frustration there, it must have taken a lot of people to throw their hands in the air and say, what the heck, right? So I get that frustration, but again, you have to remember that just because right now doesn't work doesn't mean 6 months or a year from now won't work.
Yeah, and you should never abandon the plan.
Yeah.
Like it should be like integral in a lot of your decision making, because the opportunity can come up, and you need to be able to seize it. That's where, in my business, having a lot of repeat clients is because we did that work of doing the plan. And even when we were looking at purchasing a home initially, we had a plan for 5 years down the line, maybe even 10 years down the line, and really having frank conversations about compromise and stepping stones and turning properties into investment properties as exit strategies. I think anyone who ends up watching this is like having a real estate agent and their network of professionals. Like they have to be very competent and have a lot of experience in being creative in the real estate world. It's not just about buying and selling houses. There's so much more to it. There's so many more components. Yeah, we could sell you a house in a day and you would never hear from us. But that's not how we operate. So please send us your kids. We'll take care of them.
Right.
It's pretty much the answer, because it's not that long since I bought my first house in 2016, and it's 2023 now. And since then, I think there's been like, I don't know, 8 properties or something like that with like continual planning, shaking things up, having a mortgage professional that will look at all these different hypothetical situations and kind of always be ready to take advantage of the situation.
And we actually made some of those deals work. They were limited time space to make them happen. Because I think there was a couple where the rules were changing.
Yeah.
So we were like, hey, we gotta slide this in here before this rule changes.
Yeah, for sure.
Right?
Yeah, and I think that's where a lot of people, and I think I've made maybe the error in the past when I was younger, is I didn't want to be a burden on people, so I didn't ask for help. I was like, oh, I can read this in a book, or I'll watch it online, and I'll try and educate myself. And I find that's with working with new purchasers all the time, is there's a lot of talking that happens at home and a lot of assumptions are being made.
Yeah.
And then it's like, well, if you just picked up the phone or send me an email, I'll be able to answer this very, very quickly, so you're not going down a rabbit hole. So I think like finding professionals which will give you the time and educate you is what people should be looking for, especially in a market like this one. When a real estate agent says, hey, like, just take your time with this, I'm not sure if this fits your criteria. I know you really want a house, but this only is 6 out of 10, and we want to be an 8 out of 10 or a 9 out of 10. Like, that inventory is going to come, and you're going to get that from people with experience or people who are just naturally quite calm. They know the market, the inventory really well, and they're just able to manage the situation and coach you. If you feel like as a consumer you're the one who's managing everything, then perhaps think about who you're working with. Right. Like, you're not the professional in this. Like, I sell like 30 to 50 houses a year, and that's while I've been building other houses, right? So that's a lot of experience in doing this, and so I think people should just like the purpose of these videos now that we're gonna put out there is for people just to ask more questions, and it's been really great having you here, Dan, because you offer such a different perspective, but it's so intertwined with what we're doing here.
Thanks for having me.
Yeah, it's been awesome.
I hope I talk so much I'm going to lose my voice now.
An hour and a half? We're almost a real podcast at this length.
Fantastic. We just got to come up with a name for these kind of.
I've really found. I'm going to go way off topic here. This is nothing. This is just bullshitting now. I start to really dislike podcasts that are under an hour and a half, because I find like at that hour and a half mark, I'm finally getting to some you get more into the detail. I find like the podcasts that are like 30 minutes. I was like, I need more information. Like, why did you stop? Let's keep going with this.
Yeah. So this was a perfect example of no preparation and just recording.
Just record.
We hit a bunch of topics. But if anyone who's watching this has a specific topic that they want us to talk about, then please send that into us, because then we can actually really
bring something useful to the table.
Well, I think this is all useful.
I think it's all useful, yeah.
This is sure. I think if anything, this should encourage people to sit around a group of people that they trust and learn from one another and just chat. I think we don't talk enough. We don't absorb enough from people who have got really great experience in things like real estate and business and financial planning, especially. I think coming out of the pandemic, a lot of people are struggling financially, and it's not a bad thing to talk about. I think everyone can help, I think everyone's been quite lonely over the last few years, and it doesn't have to be that way.
Let's face it, though, we live in a world that is not fair. It's not fair, right? There's winners and there's losers in every situation. So through the pandemic, there was a lot of people like ourselves in this industry. I think we all did pretty well through the pandemic.
Yeah.
And that now that interest rates are up and things are slowing, now our industry is starting to feel the pinch a little bit, right? On the flip side to that, through the pandemic, I personally know more than one person that didn't fare as fair as I did. They really felt it. But now, as they've gone through the changes that were necessary, they've either moved or they've maybe changed jobs or put themselves in a different space, and now they're flourishing again, right? So everything's kind of got the balancing effect, right? And it's no difference. I think it's beneficial for people to have people around them that help to pick them up, as opposed to sitting around and dwelling on the unfairness that you might have experienced, right? I'm not saying that you shouldn't be upset that maybe things didn't go your way, but it is definitely helpful to surround yourself with positive influences.
Yeah. Well, that's why when I went into business, I always joked around. My two favorite people were my lawyer and my accountant, and then my next favorite person was my wife. And but if you're going to go into buying a house, it shouldn't just be your real estate agent. Like we've all been saying, you need that group of people, and build up a little bit of a team. Don't go into this thinking that you're going to do everything. And if you're with a real estate agent and only a real estate agent, you have a problem.
Yeah.
Well, you're not doing, in my opinion, if you're going to buy a house, if you've made the decision to go buy a house and your first stop is a real estate agent, maybe you should think about picking up the phone and calling somebody else as well. Because really you've skipped a step, right? Right? In my opinion, your first step should be, the first question should be, can I afford to buy a house? Because if you've just gone to the real estate agent and said, I want to go see this house, they don't even know if you can afford it. Or if you'd qualify for it.
Well, unfortunately, there's a lot of real estate agents that are feeling a bit of the pinch right now in the market. So they will take that phone call and meet you and show you a property without knowing anything about you.
Yeah.
Which is, I encourage all consumers to go and meet and have a consultation with a realtor and they will give you a guide of the A to Z of all the steps that need to happen even before you step in a house. If there's a real estate agent that is not willing to open up a door for you, that's a good thing, because they're obviously saying you're probably not ready yet and you're trying to jump some steps ahead. It's really exciting to get into real estate, but we have to respect sellers' time as well in preparing a house, cleaning it, and all these other factors. It's like, do we really want to put them out? Or if it's a tenanted property, you know, tenants don't want people just coming through the house without knowing that they're qualified.
Right, those are great points.
Well, how about respecting your own time?
Yeah.
Right.
Like, I'm all for manifesting. I think it's really good when you go on realtor.ca, or you have a friend who's a real estate agent and you can set yourself up on these automated searches. That's all well and good, but you got to just do the foundations first. You know, you really do. Cool.
Does that thing stop recording?
No, I think it still goes, but it just feels weird that it's like a black screen and you're just like, has it stopped recording? Because there might be a great nugget that might.
I don't think I've looked into that camera more than once this whole conversation. I've got to stare at you guys the whole time, so I've been pretty lucky. I don't get to have the awkwardness of staring at myself.
Yeah, that would just be very odd. Cool. So, like, what's our next steps, gents?
I got to get back to work.
Good. There you go. There's business to be done. All right. Well,
Yes,
anybody who's looking for a mortgage broker, please interview Dan Macor for your, interview him. Have a chat with him. See if you guys are on the same page. And then I have personally used Dan multiple times, so he's definitely on my recommended list of a few very good mortgage brokers in Penticton. Start off with a chat and get educated.
Thanks, man.
Awesome. Thanks, man.
Good. Thanks, buddy.
That was great.
Yeah.